Okay, folks, back to part 4, talking about depreciation recapture. So here's a couple key things. All right, so a couple things to remember. What is Section 1245 recapture? Let me turn my pen on here. Okay. It means the depreciation you previously deducted can come back as ordinary income when you sell business property for a gain. Okay, basically the government is not going to let you take depreciation as an expense and then let you make money on it as well. Okay, so here's a good example. Depreciation is like a loan from the IRS. If you sell the asset for more than book value, you have to pay some of it back. I mean, basically they let you deduct all of it because you said, well, this thing's depreciating, and then it didn't. Okay? And then a comparison between 1245 and 1250. 1245 bites hard. What do they mean by bites hard? It becomes ordinary income. 1250 is a little different. 1250 has to do with real estate, and it's capped at 25%. Okay? So 1250 bites soft, 1245 bites hard. Okay? Let's take a look a little bit more. All right, so when you're looking at 1231 asset categories, there's basically 3. There's pure land right over here. And again, this is land used in business. Okay. Trade or business. Remember, this all has to do with trade or business. Personal property and intangible. Okay. This is machinery, things like this. So, and then depreciable real property comes in at 1250. Okay. So this is the 1250 item right here. Okay. And remember, this one capped at 25%. This one, ordinary income. And remember, it's got to be more than 1 year. Okay. All right. Got to be more than 1 year. If you take a look right over here, if it's held for 1 year or less, it's generate ordinary gain or loss. Okay, so remember, you'd never want to do that. Typically, you would never want to do this in less than a year. Okay? All right. All right, so here's a little bit more about what kind of property is covered here. Basically, if it rolls, let me put my pen back on. Is it on here? If it rolls or you plug it in, it's machinery stuff. Okay? All right? And basically what you do is you recapture whatever the depreciation is. And we'll look at this in an example. Okay? And if you had a loss, there is no recapture. So basically recapture is the money that you took in depreciation, the government wants back. Okay? So there's 3 basic scenarios. This one, it says you have a gain from depreciation only. The only reason why you had any kind of gain was because the depreciation you took created the gain. Okay? And this gets recaptured. The entire gain is ordinary income. Now the next one, gain from depreciation and depreciation. This is it's sold for more than what you originally paid for it. Okay? Then you would have ordinary income for part of it, the recapture, and then the other part would be 1231 gain at the lower rates. Okay? And if you had a loss, there is no loss. The entire loss is a 1231 loss. There's no recapture. So no recapture here. Okay? There's nothing to recapture. So let's go take a look. All right, so here's what, let me show you up here. This is scenario number 1. Okay? So we originally bought something for $610,000. The adjusted basis is right here. This is not an example. Okay? So what happened is we sell it for $300,000, right? Well, how did we sell for $300,000? Well, we had depreciated at that amount. So the difference between this and the adjusted basis, this is going to be 1245 ordinary income. Okay? So that's what they talk about bites hard. Okay? Now what if we sold it for 620? Okay? 620. So now we actually sold it for more than it originally cost. So this is going to be ordinary income, that entire amount up to what it originally cost us. And then this will be 1231 gain. Okay. So again, you can see this recapture thing is kind of a big deal. And then on the last one, we sold it for 180. Okay. So here we sold it for 180 and our books had it at 228. Well, now we have a 1231 loss right here of 48,000 and change. Okay. So that's what depreciation recapture is for 1245. Okay. And again, 1245, if it rolls or you plug it in, that's what you're talking about. Okay. Now, 1250 depreciation, again, it's the same type of thing, except you use straight line depreciation. Okay. You straight line depreciation and it's at 25%. Okay. This is a 25%. And for corporations, it's at 20%. Okay. And the reason why they did that for corporations, it's because they're normally at 21% now. So the 291 kind of makes it easy. It kind of makes, well, we're going to charge you 20%. It basically evens it out. Okay. All right. So here's an example of 1245. Okay. So Scrap Happily sells the machine with an adjusted basis of 6,000. So this is the book value. They sell it for 10,000. They have a gain realized of 4,000. Okay. Now, the 4,000, the first thing, okay, so we're calculating the gain. We know that $2,500 of depreciation was taken. Okay. So it says here, depreciation was taken at 2,500 bucks. So that depreciation is going to be part of the recapture. Okay. So here's what's going to we're going to take a look. How do we calculate this recapture part? So the depreciation taken was 2,500 bucks. The gain realized was 4,000. So this $2,500 is going to be ordinary income of ordinary income of $2,500. Okay. The rest of it, the other 1,500, is going to be the 1231 gain. This is the true appreciation of the asset's value and it receives the treatment. Okay. And again, this is what you wind up using in that netting process with gains and losses. So again, if you take a look here, basically it's just like that other scenario. The bottom line is, in order for you to get 1231 gain, you have to have sold it for more than its actual value. Okay. So in this case, we had a gain of $4,000, but 2,500 is going to be ordinary and 1,500 is going to be at that 1231 gain. Okay. All right. So now what about the 1250 gain for individuals? Similar type situation. Okay. The only thing is you apply the rate of 25%. So the total gain or the depreciation. The same calculations take place, but basically what they did was they limited it to 25%. Okay. Any 1231 gain above that will be taxed at the normal long-term capital gain rates. So again, similar to the 1245, just has to do with land, but instead of ordinary income, it's got a special rate of 25%. And again, 20% for corporations. Okay. And again, what happens if you try to sell something to a related party? Okay. So again, stop and think about this from the IRS's point of view. You're selling it to a related party. And by the way, related party, they don't always mean sister, brother, whatever. They could mean a company you own. So let's take a look at an example. Okay. And notice what they tell you right here. It prevents taxpayers from converting ordinary depreciation into capital gains. Okay. So Alex owns machinery with a basis of $30,000 and a fair market value of $100,000. It says without 1239, he might sell the machinery to his wholly owned, meaning he owns it, corporation for $100,000, recognizing a $70,000 1231 gain. Okay, which could be a long-term capital gain. The corporation would then depreciate the machinery based on the $100,000 cost, getting ordinary deductions. Okay. Now, Section 1239 prevents this because it makes Alex recognize the entire $70,000 is ordinary income. Otherwise, they'd let you get a capital gain, which is at a lower tax rate, okay, and then go and depreciate it again. All right, so that's what they're talking about. All right, and again, they do all of this because people were creative over the years and figured out how to use it to their advantage. All right, folks, that's part 4. Back with part 5 in just a minute.